Please note that if you currently have a 760 credit score or better, you can safely skip part 1 and 2 of the personal credit scoring tutorial chapters and fast track your new debt-free plan by moving to the next chapter in this series, where you'll begin learning all about debt weapons. Now, of course, we invite you to come back and revisit this or any other chapter in this series at any time. In this chapter, we're going to uncover some of the most insidious information of the entire training series, because we'll reveal how anyone can get any credit score faster. Now, we'll do this by revealing the magic and mystery behind the FICO credit scoring formula. Once you complete this and the other part to this chapter, the remaining chapters will demonstrate that a minimum credit score of 700 or better will unlock the power of debt weapons and how to use them easily and safely each month. Debt weapons allow the average person or business owner to do things like invest in or rehab real estate far more quickly, eliminate debt and prevent hundreds of thousands in interest costs, and considerably enhance cash flow. You'll begin learning the ins and outs of debt weapons and how to put them to use in the short videos following these. Please remember to share this powerful free education by sending the website to your friends, your family, your clients, and coworkers. We can even show you how to get ongoing coaching for free by referring your loved ones to these free classes. In the videos following this chapter, you'll see the exact steps that Dan and Megan Albright followed in a plan that they built through our coaching program by using their credit to access debt weapons and build a plan to avoid nearly 80% of the interest that they will pay the banks on massive amounts of both non-mortgage and mortgage-related debts. You'll also see them eliminate their mortgages on their primary residence and other properties in a fraction of the time and save over $200,000 in interest costs on just one financed property alone. Now, their plan could never be possible without a general education about the mysterious and often confusing personal credit scoring system. I should point out that once you've watched all these short tutorial chapters, we appreciate your feedback because it helps us continually improve the content that we're bringing all of our visitors, which unfortunately is not taught in schools. So for a limited time, we'll send you a free e-copy of Edward Jamison's book called Even the Score once you submit your feedback form. Edward Jamison is one of the most respected credit attorneys in the world, and we've been lucky enough to work alongside him and John Olsheimer, one of the original creators of the FICO credit scoring algorithm, as well as Joel Pate, Ty Crandall, Mike Citran, and several other innovators of the credit scoring industry for the past decade, which ultimately led to the inception of the 760 Club. Now, the 760 Club has been called one of the most advanced credit scoring education and enhancement programs in the country. And we're very excited to bring a two-part tutorial to you of that here today. Now, the book will help fill in some of the details that we just won't have time to cover in these short videos. But there's one more thing. By pressing the button and answering just a few brief feedback questions, you'll also receive your own free Cashflow Cruncher tool. This Cashflow Cruncher is an important tool that's used throughout these videos to help you apply the fantastic techniques that are demonstrated in this training series. Now, however, if after seeing all the chapters you'd like to skip the feedback form and simply register to get the next step in the training, which is a complimentary, customized implementation phone coaching session, and it's designed to help you and your family properly use these strategies, just simply press the other button to skip the feedback form and schedule that session. Now, after delaying for years, the credit industry finally agreed to provide consumers like us access to our personal credit scores, typically for a cost. Without proper education, many consumers just have been unable to leverage this tool properly. So having access to your credit scores and reports is similar to being handed a treasure map, because lenders use credit scores to determine who to give credit to and at what interest rates. Now, knowing how to read your credit map can be very empowering. If your scores are low, you can take steps to improve your credit worthiness. And if your scores are really high, you can take key steps to protect and leverage them in order to reach your goals far more quickly. Now, to begin understanding credit, you must learn that not all credit scores are the same. This means that when you go to a website and you pull your credit, you may not be looking at the same score that the banks look at. This is because the companies who sell your credit scores each have their own unique calculation to process your credit history. Therefore, the calculations vary significantly between companies sometimes, and in some rare cases, the difference between these scores can actually be detrimental to you. According to Fair Isaac, 90 of the top 100 largest U.S. financial institutions use the FICO credit score to make consumer credit decisions. The FICO score is a number that summarizes your credit risk, and lenders use it to make credit decisions such as your borrowing strength and the interest rate that you'll get when you apply for a loan. Now I'm going to teach you the right place to access your FICO credit score without a costly inquiry, which will harm you. A credit score is no more than a numeric calculation of your credit history compiled by three major primary credit bureaus. Those are called Equifax, TransUnion, and Experian. Most of us learn about those over time. Using formulas that these guys developed from the behavior patterns of millions of borrowers, lenders are able to assess the risk of extending you credit or lending you money. The formula looks at such things like outstanding balances in relation to your total available credit, or late payments, or the average age of accounts. Now, the more traits that you share with people who have proven to be low credit risks, the higher your credit score. FICO scores range from 300 to 850 points. And the lower the score, the higher the speculated risk to the creditor. To qualify for the best loans, borrowers generally need scores above 760, and anyone with scores below approximately 620 will pay significantly higher interest rates and may not even be able to obtain the loan. The minimum credit score that's needed to achieve the best results of using debt weapons, like we demonstrate in this series, is a 700 low FICO score. Now, because every lender has different models of what's acceptable, there's no standard scale, and some of our coaching members have achieved great results with slightly lower scores than a 700. Now, some viewers are even surprised to learn that the average FICO score, according to Fair Isaac, is approximately a 725. If you currently have a score which is lower than what you want or need, just make sure you watch part 2 of this chapter, because we'll start discussing great ways to drive the scores higher proactively. Now, keep in mind that lenders look at many things when they make a credit decision about you that go beyond just your credit scores. And that includes things like your income, or how long you've worked at your present job, or the kind of credit that you're requesting. Now, since they factor in this additional information and often consider certain special circumstances, lenders may credit you when other areas are strong, even if your scores are low. And they can also refuse to lend if your scores are high. Still, credit scores count heavily in your ability to get credit on good terms, which is important if you're going to benefit from all of the techniques demonstrated in later chapters. To learn how to optimize your compensating factors, make sure you watch all of the short video chapters in this training series. The 5 main categories of information that FICO scores evaluate, along with their approximated weightings, are: first, your payment history of 35%. Late payments have the single greatest negative impact on your score and account for a total of 1/3 of it. Now, how frequently and how recent the late payments are factored as well. In other words, a 60-day late payment made a month ago is going to count more against you than a 60 or 90-day late payment many years ago. The utilization ratio is the next. 30% of your score is based on the ratio between your total balances and your total available credit on your revolving accounts. And it's one of the most important factors in the FICO credit score. It's worth almost as much as paying your bills on time, yet many people don't learn this until later in life, how valuable it is. Owing a great deal of money on many accounts or maxing out on various accounts can actually indicate that a person is overextended and is more likely to make some payments late or make other poor financial decisions. Therefore, a score can be penalized. The third factor is the length of credit history, which counts towards 15% of the credit score. FICO takes into account how long your credit accounts have actually been established overall, and how long specific credit accounts have been established, as well as the date of last activity on certain accounts. The fourth factor is the mixture of credit. It's 10% of your credit score, and the formula will consider the types of credit cards, retail accounts, installment loans, finance company accounts, mortgage loans, etc. Your score will take into account what kinds of credit accounts that you have, how many of each, and the score also will look at the total number of accounts in aggregate. And the final factor of your credit score is the new credit and inquiries, which is 10%. Research has indicated that opening several credit accounts in a short period of time does represent greater short-term risk, especially for people that don't have an extended or long credit history. Multiple requests can reduce your score because it looks like you're either trying to get a high amount of credit, possibly because of cash flow challenges, or that you're being rejected by other lenders and you're needing to apply elsewhere. You'll also begin to learn how often you should apply for new accounts and debt weapons in the next few chapters. Now, coming up in part 2 of this chapter, what we're going to do is teach you how to take immediate action in order to optimize all 5 of these credit scoring factors. And what that does is it raises less than perfect credit scores quickly, and it protects high credit scores from lowering when making specific credit decisions. Learn how to join the 760 Club for life, and if you're enjoying the quality of the free information, don't forget to share a link to this full training series to your friends, family, clients, and coworkers. Please tune in to part 2.